Hi, welcome to the quarter one market update. My name is Jason Gunkel, and I help lead our investment team here with Severson Strage. And joining me this quarter is Lance Gunkel, and Lance is also a member of our investment team and the managing director of our firm. And Lance, thanks for joining us. I need a little help this quarter, trying to summarize all that has happened and make sense of it all. As you can see, this quarter is a little different. We're all working from home now, like many Americans, so we're recording this from home. And Lance, can you try to summarize all that has happened in the first quarter?
Yeah, well, as a result of the pandemic sweeping the world, the markets have reacted in a really brutal fashion. The numbers for the first quarter were something that we don't wish to see. If we look at the slide here, we see that stock markets across the globe were down, posting some really negative figures. The one shining spot during the quarter was in the U.S. bond market, where the bond segment held up rather well and provided some stability. U.S. bond market in aggregate was up about 3%. So there were some wild fluctuations throughout the quarter, and Jason, I know as we've talked, it's resembled something like a roller coaster.
That's right. A roller coaster would be a good analogy. And from peak to trough, the stock market fell about 34%. And so it was a quick drop. And after it bottomed, there was a few days in a row where it recovered a bit. In fact, in those 3 days, it recovered by about 20%. So technically, we had a bull market that snuck in there in the midst of this bear market. And it has been the fastest bear market in history. It only took 16 days for the market to drop 20%. And you can see on average, it typically takes about 250 days for the stock market to decline by 20% and reach a bear market. So Lance, I know you've done a lot of reading and researching on this pandemic. Can you help explain really how the coronavirus has affected the market so much?
Sure. One reason we're seeing such volatility in the markets is that while investors really thrive on certainty, we're in a period of complete uncertainty. And that is surrounding how well the world will be able to control the outbreak of coronavirus. You can see on the chart, the red bar shows what happens if no control measures are put in place. And on the opposite side of the spectrum, we see the light blue bar, which shows what would happen if we were to impose severe control measures. So this is what we've heard lately referred to as flattening the curve. And the result is completely dependent upon how effective we are. And that's why the market is trying to read the tea leaves every day and figure out from the news, where are we on these curves? How quickly can we control the outbreak and get back to living life as normally as possible?
So Lance, with the market fallen so significantly, we have had some clients ask us if they should be taking their money out of the stock market because they are afraid that it could drop further. What is your response to that?
Yeah, the worst thing someone can do is make decisions based on fear. And fear-based decision making can cause you to do things that might be not right from a timing perspective. We want to avoid trying to time the market, trying to time the highs and lows. As you can see on the chart here, the quick takeaway is that if you miss just the top 10 days in the market, you will miss out on a substantial portion of return. And if you miss out on the top 20 days, it's even further. So we know evidence tells us that it's really not possible to time the market, and we should avoid trying to do so and think with a more long-term mindset.
Yeah, that's good advice. And we don't know when this market is going to recover. We do expect that there could be some more volatility to come, perhaps a larger market drop. As you showed in those graphs before with the pandemic, it is unknown at this point. But history does tell us that on average, it takes about 3 years for the stock market to recover from a 20% drop or more. And that can vary, though. It can be a lot quicker than that. At times, it can be a lot longer than that. More recently, in 2008, 2009, it took the stock market just shy of 6 years to recover from its highs that it had reached. And we have a couple of different forces. One is trying to really stimulate the market in the form of Congress passing the CARES Act, which was the largest piece of legislation that has been passed, over $2 trillion worth of spending that'll go to businesses and individuals to try to stabilize the economy. And so far, it has helped stabilize the stock market to some degree. On the other side, you have unemployment claims that are just skyrocketing. So the first numbers came out last week. For the week ending March 21st, we had over 3 million unemployment claims, and it shattered all records before that. And then just this morning, the new numbers came out. We're recording this on April 2nd, and it showed that over 6 million people have claimed unemployment for the week ending March 28th. And so unemployment now has gone from record low levels at about 3.5% to an estimated 17% already, those numbers by the U.S. Department of Labor. And so really how far this market drops and then ultimately how long it takes for it to recover depends on how long the economy is shut down, which at this point really is unknown. Lance, we have some nervous investors out there. They're wondering what they should be doing. Can you give some advice to them about what they should be doing with their portfolio right now? And should they be selling stock right now? Should they be buying stock? What should they be doing?
Yeah. If you have a financial plan in place, the simple advice is to let that plan do its job. The plans were created for situations just like this. So first, you should have an emergency cash reserve holding at least 6 to 12 months of cash. That can be used to draw upon during volatile periods like this. That way you don't have to touch your investments if you don't need to. Second, if you are considering investing further in the markets, if you have some extra cash sitting on the sidelines, work with your financial planning team to figure out the best way to invest those funds. One potential method of doing so is through dollar cost averaging, which is investing over a period of time. That's especially important during volatile periods like this, so you don't inadvertently buy in at higher prices.
Yeah, I think that's some great advice. If you are a current client of Severson Strage and you have any questions, please reach out to your financial planning team. We thank you for your continued trust. We will keep you updated with what's going on with the markets and your portfolios. Our investment team will continue to meet regularly to see if we can take advantage of some of these drop in prices to benefit you, hopefully. If you are not a client of Severson Strage, we do welcome the opportunity to talk with you about your unique situation. So Lance, thanks again for joining us here today. We just wish everybody well out there, and please stay healthy.